Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. It is The Talking Point, Monday morning, December 11th. Thank you so much for joining me. As I look at my screen right now, it looks red, but the fact is that the market really has a need to pause. We always say, an overbought market does need to take a pause, but when a market has momentum going for it, strength going for it, it brushes aside any notion of taking a breather. But at some point, the market, just says, whoa, we need to just pause. Now, I do want to say that the market has been moving sideways, meandering between positive and negative. That's another way for a market to burn off some of the gains. But what we're looking at right now this morning, it looks as if it's going to be a negative opening. But as you know, and been watching the markets, everything can change during the day. There are today, Monday, December 11th, there are no major scheduled announcements, economic announcements. Obviously, the Fed remains in blackout period until they have their meeting this week, which, of course, is the big event. But before we even get there, I want to make a comment about last week's report on the labor market and consumer sentiment. Let's start with the labor market. The market had as a consensus estimate for the U.S. market in terms of payroll on Friday, not the ADP report, the private sector report on Wednesday, but the Friday report, it was the addition of 190,000 new jobs. And then as there were more concerns about the economy, that consensus estimate was drawn down to about 180,000 new jobs. Well, when the final print came, it was 199,000 new jobs. And the unemployment rate, which was really supposed to just stay at 3.9% based on consensus estimates, came down to 3.7%. Another thing about the report, and that is something that we were concerned about, and that is the work week. We always look at the hours for the work week. Obviously, if the economy is slowing dramatically, the hours worked also logically pulled down, but the work week hours actually increased a bit and normalized, which is good news for the economy. And the other thing, though, that we saw was that the wages remained a bit high. Obviously, they have been coming down. There's no doubt about that, but they have not, pushed lower, the kind of thing that the Fed may want to see. Now, in terms of the composition of that report, I do want to add, and this is something we talk about, is the strike, the end of the UAW strike. Those workers came back into the labor market, that attitude, as did Hollywood. What an interesting mix, isn't that? Hollywood and the auto workers together coming back into the labor market. And so that helped as well. But a good portion of the new jobs came from the health industry, the services, the broad services, and the healthcare industry. Also, the government did quite a bit of hiring. And remember, the ADP report does not include government. It's only private sector. And remember, that number disappointed to the downside. So in any event, if we take the labor report on Friday and couple it with consumer sentiment from the University of Michigan's report, we saw consumer sentiment climb higher than expectations on the back of lower gasoline prices across the country, A. B, a strong stock market, which always helps, feed an air of optimism, and the fact that the labor market remains, what should we say, resilient. The consumers responded to that. And then there was another element and component of the University of Michigan Consumer Sentiment Report, which, by the way, is extremely important, especially for the Federal Reserve. For the last couple of reports, what we saw was that consumers were saying, Yes, we understand that inflation is coming down, but we expect inflation to rise in the future. And so, despite the fact that they acknowledged that inflation was coming down, that gasoline prices were down, they pushed up expectations for higher inflation in the future. And that was fairly dramatic. Well, just as dramatic as it was climbing higher, that's how dramatic it was coming back down. That's something the Fed wants to see, because what you do not want to see are folks saying, well, inflation's going to rise. The psychology changes. It's sort of like, well, I better buy it today because it's only going to be more expensive. That you do not want to see happen. And so I think it was helpful that we saw it come back down, and I've been waiting for that because it sort of defied the fact that, again, because gasoline prices, by the way, are very important for consumer expectations of inflation. So that was helpful. This week, as we go into this week, we are paying very close attention tomorrow to the Consumer Price Index, the CPI. The question is whether or not on the core CPI year over year, does it come down from 4%? I want to tell you that the consensus estimate is that it stays at around 4%. Any move lower than that would be very helpful for the market and clearly for the Federal Reserve. So that is going to come out tomorrow. And then on Wednesday, the Federal Reserve begins its meeting. I mean, in terms of the rate decision, they start meeting tomorrow, Tuesday, but it is Wednesday that they have the rate decision, the press conference, and the announcement. But we're also going to see the Producer Price Index, the PPI. This is extremely important. And the reason is what we're looking for is the prices in that pipeline for the final product. Are those prices coming down? And that's what we want to see. We don't want to see them climbing higher. We want to see them coming down. So this will also help the Fed as they make their decision on Wednesday, December 13th. This is the market's focus this week. In addition to this week's meeting, the Federal Open Market Committee, that's called the FOMC, that's the Fed speakers that we all hear. They are in that group. We want to hear what they have to say about their expectations for growth, their expectations for interest rates. We call it the dot plot, but it is basically their economic forecast. The market is going to pay attention to that, and we all know why. It's because the market is saying, oh, well, whatever you say, the market is saying, you're going to cut rates. You're going to cut rates as early as the spring, according to the market. The Fed has been adamant in its response that no, we are not. Let's see if that still holds and see what the differences are between the market and what the Fed has to say. So that will be for December 13th. I also want to add, very important this week, also on Thursday, December 14th, will be retail sales. The reason is simple. The consumer is responsible for nearly 70% of our economy, of GDP. We want to see where retail sales fall. And I do want to say that according to the estimates, they are poised to come down just a bit. So this is going to be a very, very busy week. I could go on and on. On Friday will be industrial production. But keep in mind, the market is focused on the Fed and the Fed and the Fed. And before that, this consumer price index, because we know the Fed is watching that very, very closely, as is the market. So overall, the period for the earnings basically over, except we have some earnings left this week. We have Oracle, we have Adobe, and we have Costco. And we also have Darden restaurants. I am focused on Costco for obvious reasons. I want to hear whether or not they decide to raise their fee, but I want to hear what they have to say about consumer spending, because we know it is not just about food, but they sell so many different things. We want to hear what they have to say. And for Darden restaurants, I'm very interested because one, group within the Darden restaurant family is Olive Garden. And I want to hear what they have to say about our folks coming in. Are they noticing an increase? And also, what about the prices that they're paying for food? That also becomes very interesting because it tells us something specific about their margins. But I'm looking at it more from the macroeconomic standpoint about consumer spending. Are the consumers in that cohort that goes to Olive Garden, and I have been there for some of their specials, and I love it, and we love it. But the lines are so long. Sometimes you get hungry just standing in that line or exhausted. But I want to hear what they have to say about who's coming in, who's spending, because that will give us another very important glimpse about that all-important U.S. consumer. So again, this is a very busy week and an important week because this is the Fed's last meeting for December. We want to hear what they have to say. We know what the market has to say, but we want to hear what they have to say. What are they going to tell the market? And it's going to be important. Keep your eye on the Treasury yields. Remember, the yields on the 2-year, which is very closely associated with policy, and the 10-year inched higher when the labor market report came out on Friday. We want to hear, again, the Fed's discussion about it and see where those yields go by the time Chairman Powell is finished with his press conference. A lot for the market to digest, and the market looks as if it is trying to digest the gains until we come to the important data, CPI and the Federal Reserve meeting. Thank you all very, very much. Have a good week. We'll be back next week. Thanks again.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.